What's up, guys? Welcome back. I know that if you are learning options, just the first few days where you start to be like, all right, I'm going to learn options can be so confusing, right? Even the most basic understanding of options can be really, really confusing. And in this video, I kind of want to help you with that. I want to bring you back to where I was when I was first learning this with the calls and the puts and buys and all the vocabulary and things. Kind of give you just a very basic understanding, and we'll start with the call. Just the very basics. What is the difference between selling a call and buying a call? And what each one of those people that are doing so are looking for as an outcome. And if it goes well, maybe I'll do a put video as well, doing the difference between buying and selling a put. You can leave in the comments at the end of this video if you want me to do that one, you want to see that one. But yeah, I just want to show you and just give you like a basic, like not stock related kind of analogy and example that you could take with you to understand, just what's a call and what's the difference between buying a call and selling a call. Because inside my Discord, I see like one of the major disconnects is the word buy and sell. Because we can buy and sell options, and then inside those options, stocks or underlying assets, those are bought and sold as well. So let's clear that up to give you a foundation to move forward and continue to learn more about options. Now, the teacher in me, guys, I want to whip out the whiteboard. Sorry for the handwriting, any typos that come up. I'll do my best, but let's dive down into the whiteboard and start to just like look at a call. Even if you have no idea, like you've only heard the word call and put before, let's start there. All right, so let's define what a call option is. It is the right, not the obligation, to buy 100 shares at a predetermined price. Now, we call this price the strike price, and we can get into that a little bit further into the video, at or before expiration, okay? So here's the first place that we see buy. But this is not the buy and sell that's in the title of the video, because you can buy a call option and you can sell a call option. What this buy is the opposite of a put. This is what the contract is allowing us to do. This buy in the definition is buying the shares, not the contract. We buy or sell the contract, and then that contract allows us to buy or sell shares. In a call option, we are going to be buying 100 shares at a strike price that we determine at an expiration, and we could do so either now or up until expiration if that option is in the money. Now, here's pretty much what that means as the buyer of an option. Say we have stock XYZ, and it's currently trading for $100. Well, we're very bullish on this stock. We think the stock is going to go up in value over the next year or so. So we might have a contract that will say, I am willing to buy 100 shares at a price of $125 between now and the end of the year. So what we would do is we would buy an option, right? We would buy an option with a strike of $125. So we buy a call with a strike price of $125, and that is going to expire in 365 days. So now, if any time between now and 365 days, the share price goes above $125, I can then exercise that option, and I now have the right to buy 100 shares at that strike price. Now, if you saw my video, I'll link it down there. I'll link it down below. We don't want to exercise, but this is the example or the goal that we want. There's going to be other things that we want to do, but essentially, we want this thing to shoot up way higher than 125. Every dollar that goes above 125, we make $100 as the buyer of that option. Now, that's pretty sweet, but to be able to have that right and that obligation, we must pay what is called a premium to buy or hold that option. When you are the buyer of an option, you are the holder of that option. We'll break that down in a second. But now when I buy that contract, I must pay a premium of, let's say, $50. So now if we look at our potential profit and loss, we would see as the buyer of this call option, we would see something like this. This would be our profit. This would be the current price of the option. This is profit and this is loss. Now, when we are the buyer of an option, we have a very, very fixed loss. The most amount of money we can lose is the premium that we pay, $50. Now, once I get to the strike price, the price that I chose, $125, I then start to work my way into profit. The strike price isn't where you break even. It's where you begin to start to break even. So anywhere below 125, you lose the maximum $50. Now, why is the strike price not the break even? Well, because we also had to pay this premium, so we need to make up for that as well. Now, because a contract is written as 100 shares, right, this $50 premium is most likely going to be written as 0.5 cents. So the break even is really going to be $125.50, which would be right here. Now, here's the beauty of buying a call option. Everything above this, the price of this stock, XYZ, can essentially go to infinity. So therefore, the max profit is unlimited. Okay, now, so this is the buyer side of a call option. Now, in every single option, there are two parties. There is the buyer and the seller. So we just covered what a buy call is. Now let's look at what a sell call is. Now, a sell call, the seller of this option, also known as the writer of this option, is the counterparty to this deal right here. The option that this person bought, they bought from a seller out there in the ether world of options. So if we look, this is the buy side. And if this is confusing, I'm going to relate it to something that might be a little bit easier to understand. Stick with me for 1 second. This is going to be the seller. Then we'll also look at some of the similarities and the differences. So this same stock, XYZ, it's currently trading for $100. Now, the buyer is going to have the right and the obligation to buy 100 shares. The seller is saying, you can buy those 100 shares for me at the strike price, okay? So the seller is saying, buy my shares for $125. Maybe they've had these shares for a while. Maybe their basis is 100. They would love to make $125 on that. That difference of 25 times the 100 shares, they're going to be good. So they have an opposite belief of what this stock XYZ is going to do. The buyer thinks it's going to go to the moon. The seller's like, nah, this thing's going to trade neutral or go down. So they have different goals or different predictions of what this stock is going to do. So the seller pretty much holds out a contract and says, hey, I'm willing to sell my 100 shares at a strike price of $125 anytime between now and 365 days from now. And they hold that out into the world, and then the buyers come along and they say, I'll take it. I'll take it. Now the seller, they don't just give this away for nothing, right? When you sell something, you get something in return. When you buy something, you have to give up cash. So the seller's holding this contract saying, hey, who wants 100 shares at $125 anytime between now and 365 days from now? The buyer says, I'll take it. Seller says, hey, I'm going to need $50 for that option. So the $50 that's paid, that goes into the seller's pocket. Now, this is known as like selling covered calls. If you've heard of this, you have 100 shares, you use that as collateral. In this case, the buyer side, the only collateral needed is the premium to put up. When you are selling, you have the 100 shares to sell, so that is going to be your collateral, and that makes the profit and loss graph look a little bit different. If I look at it from the angle of the seller, right, where this is profit and this is loss, this is the current strike, 125. Now, for this case, when you are selling, the most amount of profit that you can make is $50. And that's if the share price does not go up, and this option would then expire worthless. So you get that to here. Now it approaches the break-even line and goes down here, and what we see when we are selling an option is we have unlimited loss. Now the thing with this unlimited loss, it's really only a loss in potential capital gains. For example, I'm willing to sell this at $125. If it shoots up to $250, I now have to sell a $250 stock for $125. I still made that difference of my basis, but this stock can go up for a really, really long time. You don't lose money, you lose the potential for capital gains. So to summarize this, in the buyer side, right, we have a fixed loss. On the seller side, we have a fixed profit. On the buyer side, we have unlimited potential to win. And on the seller side, we have unlimited potential capital gains that we could have kept if we held the stock. Now let's put this in simple terms. And I'm not sure exactly where I heard this. It was probably Investopedia.com, because when I was learning options, I read that stuff a lot. But this really helped clear up like the difference between buying a call and selling a call, and the option buying 100 shares and selling 100 shares in the put side. And like I said, if you want me to do this breakdown for the put, just leave in the comments below. I'll do it. But let's say this. I'm a potential home buyer. Here's me. I'm looking to buy a house, and I'm looking on this street, okay? Now, on this street, there are a couple houses. And these houses range anywhere from $125,000 to $150,000. Now, I'm looking at this street, and I'm like, okay, that's a pretty good deal. These houses are kind of old. I kind of want to do them. But then I hear in the news that a developer is looking to come in and build 2 new, brand new, state-of-the-art houses on this block. Now, you might be thinking to yourself, oh, wow, I'm really bullish on this block. I think that the properties, all of these properties, are going to double and maybe even triple in value. And then you hear that these houses are only going to go on the market for $160,000. And you're saying to yourself, in the next 3 years, those houses are definitely going to be more than $160,000. So you call up the developer and you say, I want to buy one of those houses for $160,000 between now and 3 years from now. But you don't really know if it's really going to be worth $160K. You just kind of have an idea, right? It needs to be built, and we need to see what happens over time. So the developer says, sure, I'll give you that right to buy one of those 2 houses for $160,000, but you are going to have to give me a $50,000 deposit. And this deposit is going to be non-refundable. Like I said, things are going to be happening. It's already past the board. It's going to be built. It's fine. And you're like, that is dope. I'll take it. You give the developer your $50,000 down payment, and now you just wait until the houses are done, and you have the right to buy one of those houses between today and 3 years from now. So let's look at the possible outcomes here. 2 years from now, all of the houses are up, and they're built, and the current value, it's appraised with appreciation and everything, now they're selling for $320,000. Boom. You right now have the option to exercise that contract you had with the developer. You give them the $160,000, and boom, you have now doubled the value of that home. This is essentially what you're doing. Guys, the seller, this is the developer of the option. The buyer is the person looking for the house. The house is the stock. The current trading is really what the neighborhood is really looking for. Houses are supposed to appraise somewhere in the neighborhood of $130,000 to $150,000. But you want to buy a contract to buy it at a fixed price at some time, and to do so, you are going to pay a deposit for that. And the deposit, or the down payment, is the premium you pay. You pay that down payment over here to the developer, and then we see what happens. But we also have to look at the downside. Let's say things turn up and things don't go well and the house doesn't get built, or something happens in the neighborhood. They find out there's a toxic lake nearby, and 3 years from now, the house is only worth $100K. Well, now you can't exercise that option, and you're out your $50 deposit. The same happens when you buy an option. If the share price doesn't ever reach the strike price that you chose, you lose your premium, your max loss, just like you would lose a deposit. I don't know if that example helped. Like I said, it helped me when I thought about it. So if you're the buyer of an option, you're going out there and you're looking for a seller, somebody who has a contract, 100 shares, to buy 100 shares at a price that you think is a lot less than what it's going to be in the future. You get to choose that buy and you get to choose that expiration. Now, why would you do this as opposed to just buying 100 shares and riding it out over the course of a couple days, months, and even years? Well, because to pay a premium to buy those 100 shares is often going to be far less expensive than the cost to buy those 100 shares. And like I mentioned earlier in the video, oftentimes we are going to close this before expiration and make profit on other things that are a little more advanced. I'll link a couple more videos and you could see why you never want to actually exercise the option. But that's kind of the play. When I buy an option, I think that it's going to go up. When I sell an option, I think the share price is probably going to stay neutral or go down. I like collecting premium as the seller of a call option, and sometimes I'm willing to pay some premium as the buyer of a call option. Any questions about it, guys? Leave it down in the comments below. I will be sure to get to it definitely within the first 24 hours of this video posting. If you want to jump in and talk options with a group of like-minded individuals, my Discord now is over 400 people, over 1,000 comments per day of actively trading, people in there just like you and I. I'll leave that link down in the description below. Until I see you guys in the next one, stay positive, work really, really hard, always please be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.